and they keep rising. Both sides of the Atlantic. Welcome to the webinar, one and all. And we're going to get straight into it. Listen, feel free to ask questions as you wish. What I'll do is I'll answer them at the end, but it'll be good to see them. Hello, Peter, Sunny, Auckland. I wish you could send a picture on here. It'd be good to see. Let me know where you're all from. Let me know if this is your first time as well. We're going to start a poll. We're going to do a few polls just to share knowledge amongst each other of what everybody else's outlook is. We've got quite a lot to cover, so I'm going to get on with it straight away. As I said, I'll keep an eye on the chats. We've got North Wales, we've got Glyn. Welcome, everyone. It's a really good time for you to be on, given just how much is going on with the markets overall. So thanks, everyone. And yeah, grab a comfortable seat. Grab pen and paper as well. You'll want that. You should be able to see the screen. You should be able to hear me all. I feel like a pilot. So buckle up. It's going to be a smooth ride to our destination profits. Okay, now, first and foremost, this is not, well, just read that really. Just read all of this. It's information education. I'm not soliciting you to buy any individual stocks because I don't know individually, so it's not financial advice on an individual one-to-one basis. Now, this is who I've targeted towards. Don't worry about reading all of that. Retirees and the problems I'm going to address in this webinar that you're facing are the fact that you've got low risk tolerance, you've got unfamiliarity with strategies, but you do want to extend your savings, you want to be more educated and informed, and you're the ones who want to maximize your returns, manage your SIP. So the solutions I'm going to talk about in this webinar are some strategies, some safer growth emphasis through exchange trade funds, lower volatility, and just give you transparency of what moves markets. The next group of people are business owners. By the way, feel free to whichever category you're in to put it into here once I show you all the categories. Now, you've got limited time and a lack of expertise. You're motivated to maximize your returns and have some tax efficiency in there. So we're going to talk about a process during all of this stock market update, which gives you minimal monitoring and higher returns as well. We've got Isha, London. We've got the US. Fantastic, Rakesh. As well, Marguerite, bonjour. I think you're in Paris, aren't you, Marguerite? And then we've got the self-employed professionals, okay? So you may well be the accountants, the lawyers, the dentists, the freelancers, the contractors, the IT guys. You're unfamiliar with investment options, hesitant to take risks. I fully understand that. You want tax relief, obviously. You want higher returns. And we're going to focus on, well, teaching you what moves prices, make sure that the strategies are ones you can understand, are straightforward for you, and again, save you time. So they are the various groups. Now, I've always said in one way, simplest thing that everyone's looking for is, okay, how long does it take to double money? It's as good a target as any. If you're with St. James's Place IFAs or wealth managers, the typical ones will just try and get you to be around the 5 to 6%. And basically, they need to milk your assets for 14 years to make sure their kids have got through private school through the fees they're going to charge you. Okay, so this is where your sort of St. James's places. To give you an idea, the S&P 500, just a simple index tracker, forget anything that I might be able to do, is around here over the last decade in sterling terms. Okay, its long-term average is here, so it takes you 7 years to double your money if you get the long-term average. If you get the recent 10 years, you're at 5 years. And if we can cherry pick some of that, maybe do a little bit better, then we might move down here. Personally, I don't see much of a difference between 5 years and 3.8 years, which is actually a big, massive 5% gain, let alone if you have some great years where you get a 40% gain, like the last 2 years have just happened to be very good. But to be honest, if you're doubling your money anywhere in this bottom half of the graph, I think most people would be happy. Okay, so we're going to look at, is that possible? And if you don't feel confident enough, just do an index tracker. We'll look at all that. Well, here you go. 10-year annualized returns by asset class. JP Morgan. So the S&P was 16.6%. Sorry, I undershot it, didn't I? 16.6. Your average investor, sadly, is getting 8.7. Why is the average investor doing so poorly? And this is JP Morgan Asset Management, okay? One of the leading firms. They've got their data off Bloomberg, etc. Well, the average investor tends to exit too quickly, doesn't know what they're doing. Usually is with St. James's Place or IFA or wealth manager. I really am going to stick it to them, I'm afraid, in this. So the average investor, as we all know, does, well, half as well as just the index tracker, which is, I guess, why Warren Buffett says if you want a simple improvement, just do that. But this isn't the sum total of my message, just to do that. I think it helps if you understand why, what, get some transparency, and, like me, want to try and beat it. okay, and try and do better by just cherry picking. So there you go. That's the S&P. In actual fact, that'd be higher now, because if we take 2023 and 24 into those, that jumps a fair bit. But let's just take 16.6. So where does that get you? Well, that would mean you were doubling your money in somewhere between, well, about 4.5 years. I think most of you would be happy if in the next 4.5 years you doubled your pension, wouldn't you? Okay. So let's look at how some of that might happen. Okay. Thank you, David. Business owner, but past retiring age. Thanks, David. Also good to know if others want to share which groups they're in as well. Hi, Swanee from Birmingham as well. Jeff from Malaga. Be good to see you again, Jeff. We'll try and do another Great Investments Program sort of summer school. Now, this is valuations. Just to give you an idea of where valuations are. You're paying $27 for every, when you buy a share in Microsoft, you're paying $27 for every future dollar of profit. Okay, that Microsoft has. So if it was a house which produces rent of $1 a year, you're paying $27 to buy that house and get rental of $1 a year. You decide whether that's good value or not. There's another house down the street called JP Morgan where you're paying $13. If valuation was the only thing that moves stock prices, then you'd buy all the ones in green, you'd sell all the ones in red, and you'd be rich. But obviously value isn't the only thing which determines the future movements of stock prices. For instance, growth does, or anticipation of growth, expectation of growth. So the anticipation that NVIDIA might create some amazing things, or Tesla might send people to the moon, is why people are willing to pay more. So that's why we don't just look at value alone, because if we did, we would have ignored all these ones in red, which is why all the people you see, the journalists you see screaming that, oh, the market's overvalued, we must sell it. What they don't understand is, quite frankly, I don't care whether it's overvalued or undervalued or sideways valued. What I care about is if I look at valuation, growth, income, momentum, all the other factors that I'm going to show you, and I tick all those boxes relatively quickly using an Excel spreadsheet to pull out all the data from the various exchanges, from the balance sheets, from the cash flow statements, and everything else, can I make money? That's what I care about. Okay? I'm not trying to outsmart the rest of Wall Street or anybody else. I'm not trying to see into the future. I don't have a crystal ball or a time machine. What I'm trying to do is avoid any stupid mistakes by ticking all the boxes of value, growth, income, cash flow, Sortino. Once I've done all of that, which I'll show you in a second, if there's a tailwind, I'll make money. If there's a headwind, like 2022, I end up having to hold, worst case scenario, I end up having to hold cash most of the year and get 0%. 0% in 2022. But if there's a tailwind like the last 2 years, then it's not because of me, but it's thanks to NVIDIA that we do ridiculously well. Okay, it's not because we found some clever little company. What people mistake this for is they think, oh, it's some kind of tipping service like Motley Fool or something, where the journalist breathlessly says, I've just discovered the next growth thing. I track the airplane movements of the directors of NVIDIA, and I think they're going to, no, I'm sure that might be a way to pick companies, or there's a million other ways. Astrology might be another way. We don't do any of that. We just take a very data-driven approach, which is backed up by the works of 3 economists that I've written about in my 18-odd books, my 200 Financial Times columns. Those 3 economists are Richard Thaler, Daniel Kahneman, Eugene Fama. They all went on to win the Nobel Prize in Economics. I've got a TEDx talk coming up at the end of this month, my 3rd TEDx talk, where I'll be discussing that and why the scientific approach, which copies a Warren Buffett data-driven approach, or copies Jim Simon's most successful hedge fund manager in history at 39% per annum returns after fees for the last 30 years. That hypothesis, test it, result is far better than hunch, guesswork, and gambling. All right. These are some of the results due to come out. Now, the big ones have already come out. That's the main one you want to keep an eye out for. To some extent, Eli Lilly, you can take a picture of this, but more importantly, it's a busy earnings season, and it's going to give some direction to the markets. I think at the moment, the markets haven't been spooked as much as people thought by anything, whether it's been, I mean, there's been some short-term noise on Apple or Alphabet, but it's nothing which is, and we'll have a look in a second, which has decidedly moved things lower. I'll tell you something interesting. I'm going to have to look at Becton, because I'll tell you why, and I don't mean to be superstitious. It's come up on my filtered list. It's come up when I put all my data into AI. And it's just caught my eye again. I don't own it. I'm going to have a look at this. And I'm not recommending it because I need to deeper dive into it. But given that it's come up about 3 odd times now, I'm not the superstitious type, as I just said. I talked about scientific approach, and then I tell you. But yeah, it's one I'm going to look at in more detail later. Now, what have we got? On Friday, you've got some more. None of these will be market moving in and of themselves, unlike, say, an Amazon, Alphabet. Those can be market moving, but some of the big players, and there'll be a lot of noise in the market coming out. And if you own any of these, you might want to keep an eye out for them. We're going to discuss some of these in this call, like CVS Health Corporation as well. Oh, we've got Australia as well. Occidental, I'm going to cover one in a second in this webinar as well. Chaz, business owner looking to retire early. I understand. You heard a child's voice heard. Marguerite, would you believe my 7-year-old son is still not asleep? I know, it's bad parenting of the highest order. Don't forget to do all of those things. Now, the other thing I want to show you, let's look at that poll. We've got enough time to do the poll. 51% of you think the FTSE will end up high by the end of the year. Fair enough. Okay, the rest of you are not sure, so it's pretty close. Let's look at the Dow. Okay, and I'll give a poll on that. So this is like what I said. I want to look at 10,000 companies. Every company is a factory for making money, and they're basically individuals. A company is an individual, which is a collection of individuals which are saying, I want to manage your retirement. I want to manage your children's inheritance. We've got Swanee, haven't we? Swanee, if I've pronounced that correctly, Swanee, let me just address it to you. So each one of these companies is saying, I want to manage all the money you've earned in your business, and I want to manage it for your children's future or your retirement. So if you're going to hire somebody to do it, would you not want to look at the CVs of all 10,000 companies? Because they're all standing to do that. You would. And that's why we look at 10,000 items of data, 10,000 companies rather, and across each company, we want all of these things to be these first 5 columns. So that's 50,000 points of data. We actually look at more than that to discount and discard the others. And out of 10,000, there's only about 200 which have all green. Now, why are these green factors important? Well, we know undervalued companies do better than overvalued ones. Not guaranteed to, but as a general rule. Growing ones do better than ones which aren't growing. Croaky comes from Goldman Sachs Wealth Management. I'll show you the slide later. I stole it from them. Their R&D department discovered that companies in the top 25% by cash return on the capital they invest, the amount of cash they get from the capital invested. In other words, how close are they to creating a cash cow? Okay, or license to print money. Croaky, cash return on capital invested, license to print money. They have a print machine to print money. The ones in the top 25% perform about 30% per annum as a basket of stocks on average. Not guaranteed, not every stock in that basket, not every basket every year. As a general basket, 30% per annum. So we want that to be green. We want this to be green because it gives us the value growth income. This comes from partly from the economists that I mentioned. This comes from Goldman Sachs. These 3 come from the hedge fund industry. So I've taken the wealth management banks like Goldman Sachs and Croaky. I've taken Nobel Prize winning economists, and I've taken hedge funds. The hedge funds this comes from, by the way, if anybody's interested, because it's momentum related, includes the philosophies of Winton, Capital, Aspect, Renaissance Technologies to some extent, Man AHL as well, because they're all momentum based. Okay. And what the theory there is, momentum tends to persist, but isn't guaranteed to. Even if it gives you more than a 50-50 chance, just edges you into 51%, that's enough of an edge to make a killing in the market. Sortino is average return. Now, this is absolutely essential for the hedge fund industry, the industry I come from. If when you go to investors, and I'll show you one of my first investors into my hedge fund, I'll show you a picture of him because today he had his ceremony to be awarded the CBE by His Majesty the King. So I'll show you that later. But when I go to people like him, or I did 20 odd years ago, and said, would you like to invest in the fund? Sortino is what matters. The average performance, okay, versus the risk of missing it in any given year. There's no point if you've got, take 2 cricketers, both getting 50 runs on average. You think, oh, they've got the same performance. They're just as good. No, they're not. One gets 50 every single game. The other one might get a century or a duck. They're not the same thing. Okay, you want the less volatile one so that you've got greater certainty of return and less likelihood of missing it in any given year. Obviously important. That's what that measures. We cheat. We just look at the stock prices to get that. Doesn't guarantee it'll continue doing that in the future. All of a sudden, the cricketer's doing great every single year, and then the 1 year you pick them for your team, how often does that even happen in football or cricket? They're out of form. So that happens with companies. They go out of form. X factor. What can you do? Okay, can you predict it with football teams? No. Can you predict it with cricketers? No. What makes you think you can predict with companies? All you can do is look at every single piece of data and say, let's make sure we don't make any stupid mistakes because it's our hard-earned money. That's why when I started doing this over 20 years ago and writing about it in the Financial Times in my weekly column, and that's how it developed. Each week it just evolved and developed because I was reading all the academic literature and publishing it in the paper. And then I thought, why didn't I use this myself? And it built it. The most important thing for me was start at the top. Start with the Goldman Sachs asset management company. Start with the hedge fund. Start with the Nobel Prize winners because it's my money. Whereas most people, for some unknown reason, when it comes to their pensions and retirements, they just roll the dice. It's like, have you not worked your whole bloody life for this? Did your parents not sacrifice so that you could have an education to earn this money? And now you're just rolling the dice on your pension with the St. James's Place and saying to some bloke who passed a multiple choice test to become an IFA, oh, go manage it for me. Are you kidding me? I don't understand people. It's crazy. And that stuff comes from Daniel Kahneman and Eugene Fama, again, the Nobel Prize winners. So we want to tick those boxes. Still doesn't guarantee it. Still doesn't guarantee. I'll tell you why it doesn't guarantee it. Donald Trump do a tweet. That's probably the best way to explain to people that there are other factors outside of our control. Okay? I was about to say some are in the hands of the Lord. I'm sure he thinks he is. Past week, this is how it's looked. That's pretty sharp and volatile. Okay, it's pretty unusual for Microsoft to drop 7%, but we'll come to Microsoft in a second and what I own as well. We'll come to Broadcom. That was selected by AI in March of 2023, as some of you will know if you follow my Telegram channel. And it was a surprise because we had a bunch of stocks and we said, like, pick the best ones out of this 200, and AI came up with that. I didn't know it was going to do as well as it's done since then. I think it's gone about 200-300% since then. We'll talk about Palantir in this as well, and Walmart and Costco will come across, and we'll talk about some of these as we go along. But anyway, that's the past week. Don't read too much into this. There's a tendency for humans. There's a great book by Nassim Taleb called Fooled by Randomness. There's a tendency for humans to see patterns in everything, and they see it too soon, and they're fooled by randomness. This is just noise. Okay, we'll get into the deep down what's actually going on. Right, over the past year. Now, if the next 2 years look like this, I'll be very happy. For the simple reason that the past year has been rather good. There were some 51%ers, 24%ers. Yeah, there were some 2%ers. Had I known it was only going to be 2% and this was going to be 88, I would have put all my money in this and nothing else. And to be honest, if I was an emotional person, then emotion kills investing capability. Okay, if I was an emotional person, I'd be crying about a lot of things, i.e. all the big fish that got away. And I'll talk about that in the course of this webinar as well as we go through. Now, let's have a look at that poll. So 60% of you think the Dow will be up by the end of the year. The rest of you are either unsure or say no. And that's perfectly fine. I'm going to reset that poll. I'm also going to put another poll up and address that question, and just keep an eye on all of this. Can't read aloud. Thanks. Alan, you're on a phone screen. Don't worry, it'll be recorded, Alan. You could watch it on a big screen later. I'll just go those columns again, Alan, just for you. So the columns were value, growth, income. So we're looking at undervalued companies which are growing. And you raised an important point, Alan, which is, you see, average fund manager will say, oh, I'm going to buy you a value stocks through a value fund manager, and I'm going to buy you some growth stocks through a growth fund manager. Well, actually, if a fund manager can only buy undervalued companies, they might be undervalued because they're rubbish, and you've restricted him to just only a few companies, i.e. undervalued ones, or only British undervalued ones, only European undervalued ones, which all sounds good, except here's the problem. That's like saying, let's try and win the World Cup, but only pick people from Watford. Okay, so to simplify statistics for you. So we say, well, we want companies which are undervalued, i.e. low price compared to the profits they're making, but also growing as well, i.e. revenues are growing each year, profits are growing each year. Revenue and sales means the same thing, profits and earnings mean the same thing. Okay, and have a dividend yield as well. Now, those things aren't guaranteed to make prices go up, but we know from the academic literature and the research done not just through academia but through investment banks that companies tend to perform better that have those characteristics than the ones that don't. So why don't all funds do it? Because they spend so much money in marketing, like a St. James's Place. Everywhere you bloody go, there'll be adverts on, every website to take your capital, that when they've got hundreds of billions under management, they can't just say, oh, we'll just buy the best companies, because if they buy 20 of the best companies, they'll end up taking them over because they've got to divide 100 billion into them. Okay, and it's far more lucrative for them to sell you a UK fund, i.e. funds by geography, style, and by theme. So, we'll send you an artificial intelligence fund and a this fund and a that fund. Plus, if they sell you more funds, then they know in any given year, just by random chance, some will be up, some will be down, and you'll be happy because you'll go, well, that one, he got that one right. You can't get everything right. Anyway, the asset management industry is I'm going to just call it a scam. The retail asset management. I've published it in the FT. I've published it elsewhere. But forget me. Eugene Fama got a Nobel Prize in economics for pointing out that data. Okay, for pointing that out. 2018. So let's go into this part. The valuations, US market price to earnings, okay? You're paying on average $31 for an average stock in the American markets, or rather for if you're buying the market as a whole, okay? For every dollar of profit, you're paying $31. So imagine they produce $1 in rent and it's a property you're buying, you're paying $31 to buy that property, which makes $1 in rent a year. Is that expensive? Well, one way to judge it is historically, what is it? Well, it's not actually shooting the sort of blowing the doors off. It's not overly expensive. One of the things that the American market's got going for it is, whilst the market capitalization, the price basically of companies has risen to 63 trillion, i.e. went up 24% last year, the profits, and that's the thing you got to watch for. There are only three things that can cause a crash, and they're the same three things that all companies produce. They're in their accounts. It can either, the crash can come from the P&L statement, the cash flow statement, or the balance sheet. Let me explain. A balance sheet crash is like 2008 financial crisis when the banks discovered the houses weren't worth what they thought they were. In other words, their assets weren't worth what they thought they were. That's where the balance sheet was rubbish and people realized they were overpaying. So you get a crash and they revalue. That's 2008. An earnings related crash, P&L statement crash, came in 2000 with the dot-com crash. Oh shit, people aren't making profits. Maybe we're paying too much for companies. Easy to understand. Cash flow crash, COVID, 2000. Close all businesses, there's no cash flow coming in. Prices plummet. Okay, so the only three things that can cause crashes because they're the same three things that the accounts of a company come from. And the thing to keep an eye on during this earnings reporting, the Americans report 4 times a year, they're more transparent than the British, who only report twice a year, is total earnings coming out of companies. And that's up 13%, but the prices are up 24%. So yeah, there's some price inflation, there's some overgrowth. It's got more expensive. Revenues are up 6%. As long as these two numbers are up and not too far away from that one, we're okay. But we'll keep a close eye on things. That's why I do the market update each week. I don't look top down. I look bottom up. In other words, I look at individual stocks. But top down, this is the US market, price to earnings. That's the valuation measure. This is the growth measure. And ideally, you want undervalued, high growth. Okay. But I don't care for what sector they're in. I care for what the company's doing. We can argue the toss on that some other time. But those are just some numbers if you want to look at them. I'm not going to pore over it. You might say, well, bloody hell, energy's cheap. Yeah, but the growth is low as well. Well, surely we want something which is high growth, but cheap down here. Yeah, is it something in the middle? And there's a mathematical formula you could use, but there's other factors we use than just value and growth. Okay, how are things gone? Over the last 7 days and over the last year, Alphabet, 41%, 54% on Meta, Broadcom 81, Palantir 374, Amazon 43. Bloody hell. And if that's all you had and that's your pension, you're laughing. If all you had was Alphabet and your pension's up 41%, you're laughing. Of course you are. But who would put all their money in just one company? Look, we'll have a look at all of these during the course of the webinar. For the UK markets, this is the UK price to earnings ratio. It's at 18. Okay, it's cheaper than the US, but the US is expected to grow more. That's why this has got a lower price to earnings. Okay, whilst prices have gone up, guess what? Revenues have gone down, and so have earnings in the UK. So the UK, bit of a concern, but we'll have a look at it as well in a second. Sana, thank you. And Alan, I will have a look at all of the questions. I'll do them at the end, but don't worry. I will be discussing Alphabet as well. And this is the UK market. Valuations, what's expensive? Consumer staples, but forecasted growth. So there is some forecasted growth. I mean, that's blowing the doors off in real estate, apparently. But then again, that's factored into the price. You know, when they say it's in the price, yeah, because the multiple, you're paying $72 for each dollar of expected profit. I'm not bothered about the sector, so I'm not going to talk about it and dissect it and make some complicated assessments. You can read into it what you wish. I'm going to look at the individual companies, okay? So let's get into those. This is the UK market over the past 7 days in the last year. Everyone's on a plane. I don't know if you've been on a plane recently. It's certainly a British Airways one. It's rammed. And I'm talking from business class to economy. It is just rammed. Does anybody, what the hell's going on? Is it some kind of air miles thing? When did people start blowing $2.5, $3 on business class flights, cash retail? Yeah, we're not talking, I mean, business class used to be business flyers. So I don't know what's going on. Some people say it's because people realize after COVID they've got little time to live. Others, I don't know. There's something going on. I've not worked it out yet. If somebody could tell me the psychology of why people are paying so much for business class flights, or are they getting some kind of deal that I'm not aware of, in which case I want to get in on it. But back in the day, only businesses played business class. I think now you've got retirees. Is it the boomers who are selling their homes and living off your future inheritance? Are they blowing it all and saying, well, screw the grandkids? I don't know. I honestly don't know. Okay, so some good movers. We will look at some of that, I think, during this. These are the exchange traded funds. Now, I often neglect these. I'm going to do a separate webinar on exchange traded funds. Okay, but just so you know, this is 1 month performance. This is year to date performance. Okay, and I'm not going to go right now into, you know, Singapore ETF or gold. There's a lot of gold ones, obviously, and gold's done rather well. Will it continue? I don't know. My wife bought some gold coins recently. We don't keep them at home in case anybody is thinking of doing a raid. And Brazil up here as well. Germany. I will do a separate one on these, okay? Because just because they've gone up, you can't just look at momentum and say, oh, well, that's fine. Let's go into momentum. That'd be a stupid thing to do. Value, growth, income, Sortino, alpha. We want to look at all of those things before getting in. Year to date, where are we? Well, the UK actually isn't doing too bad. Now, the reason the UK is not doing too bad is because the pound has weakened, or rather, the dollar has strengthened. The pound has weakened partly because nobody believes Liz Truss. Liz Truss Mark II, Rachel Reeves. Nobody believes Rachel from accounts. And what that means is the pound has weakened because we're not expected to grow as much as they belatedly realize we might want to. And also the dollar has got stronger. Okay, Trump, whole variety of reasons, the dollar's got stronger. I won't go into all the reasons to do with interest rate differentials, expectations of inflation, speed at which interest rates, the Federal Reserve will reduce them, current account deficits, all the rest of it, tariffs. Dollar's got stronger is the bottom line. In other words, get this, you're going to love this. What happens when the dollar gets stronger if you're an American? Imports get cheaper. Your dollar buys cheaper imports because stronger. $1 is worth more, so it buys cheaper imports. All these journalists telling the Americans that your prices are going to go up. Well, first of all, you're not forced to bloody eat avocados. Oh, your morning coffee's about. Don't have freaking coffee then. As Warren Buffett's always said, if you keep buying stuff you don't need, one day you're not going to have the money for the stuff you really do need. Anyway. And the second thing is, dollar's got stronger anyway, and it's counteracted the impact to a larger extent, which is one of the reasons I think the stock market's not tumbled. It's like, yeah. And the second thing is, journalists are not usually well schooled and briefed in business strategy or negotiations. The first thing Trump says is not actually the thing to focus on. So they're all focused on, I mean, whether it's about Gaza or anything else. Oh, God, he's going to move. How stupid, you can't do that. How ridiculous, ha, ha, ha. What you got to think about is he's thinking, so the next thing you're going to say and the real thing he wants. It's just how all negotiations work. Okay, so I don't want to get diverted into politics and all the rest of it. But similarly with the tariffs, it's not, we're going to put tariffs on you. It's, well, if I threaten to put tariffs on you, the next thing you're going to do is X. And what I really want is Y. Okay. I mean, it's been like that forever. Cuban Missile Crisis. I mean, the Americans sort of first realized it then, when what the Russians really wanted wasn't actually nukes in Cuba that close to the Americans. They wanted the missiles out of Turkey. That was the face-saving trade-off. Anyway, so where are we on this? Not too bad, is it, at the moment? More importantly, I'm going to come to another chart on this. Let's have a look at this. Year to date, these are the sectors. I don't care. I don't care that it's communication. I do not gamble and try to see into the future and guess that which one of these horses is going to be the best performer. Is it going to be energy, or is it going to be communications, or is it going to be healthcare, whatever? I care about the companies. If the companies are good, then of course, if they're in a sector which is going up or in an economy which is rising, if there's a tailwind generally, they'll do even better. Okay, but I'm not really bothered about the sector as I am about the company's financials, balance sheet, cash flow, P&L. Very much a Warren Buffett type approach. At the moment, if you look at the styles, momentum is the winner. Now, we pick stocks, as I said, to avoid this problem of trying to guess what's going to win. Is it going to be growth? Is it going to be value? Is it going to be volatility? We make sure, as I've already explained, we have a set of, do you remember your Venn diagrams from school? Value stocks, and within those, which ones are growth, which ones within there are momentum. So that way, we're picking the ones which, well, I guess in a way it's this. We want that bit where A intersects B intersects C. Okay, if you remember your Venn diagrams, this is what it looks like. Okay, and that equals a very small subset of companies. And that's why we do it. Because I don't know which, if I only try to pick momentum ones or only value ones, then I'm taking a greater risk, because the other factors might overwhelm it. And the momentum one no longer goes up because guess what? It was overvalued and wasn't growing, right? Markets over the past year, not bad. NASDAQ 22%, S&P 22%, Dow 15%. But I want to teach you something about investing. Imagine that was a stock. Just imagine it's a stock and not. It is actually in a way a stock, because you can get an index tracker on each of these. But imagine it's a stock. Call it XYZ company you invested in, or imagine it's your pension, which is a collection of stocks like this, or a collection of stocks. And if your pension went up 22% in a year, you and I would be very happy. Okay, we'd say, yeah, I'll take that, up by a fifth this year. I can double my money in about 4 years at this rate. Fantastic. Here's what that involves, and this is why retail clients get a piss poor performance of around 8% or 6%, as you saw from that JP Morgan image. Because the way it moves is this. There are 4 ways the market can move. It can, of course, move up, or it can move up, then down. And you can see here, you had a 0% return from January until about May. Okay, so way number 1, it moves up. Great, everybody's happy. Or 2, it moves up and then down. Well, not so good, is it? The next way is it just goes sideways for ages. Look at that, 0% return. Look at that, 0% return, 0% return. Very long periods of nothing. Okay, if you look at the purple line in that. So that's 3. Okay, it goes sideways. Again, not very good, bit bloody pointless. And the 4th way it can move, obviously, is the obvious one. It falls, as it did there, there, there. All right? Now, out of those 4 ways, only 3 of them aren't giving you a return. Only 1 of them is. So only roughly, as a rule, you should take it that 1 time out of 4, does the market do what you want? What am I saying? As Warren Buffett said, the market is a way of transferring money from the impatient to the patient. The impatient get out here. Okay, sorry, they're in here, they get out here, right at the bottom of the market, they get in here, they get out there, they just F it up constantly. They mess it up constantly. I'm going to see if I can clear the ink. There we go. So they lose all the money, then they make it again, then they lose all the money. So by this stage, you've gone from January until August and made nothing. January to August, you made nothing. 8 months, you made nothing. And yet you had a 22% year in which your pension went up 22%. All you had to do was sit on your hands. Why don't people do it? Because they don't realize this happens. Okay? They don't realize that that happens. Now, from that doesn't irrationally mean every time you make no money, you're going to make money. No, if you've got something which is good, what's good? Value, growth, income, cash flow, Sortina Alpha. Unfortunately, it'll move like this. How do we know? Because I've just shown you it does. Look. Okay? If it's rubbish, it'll only keep falling. That's why we're trying to avoid rubbish, right? So When you understand how the prices actually move, then you're left to the point, which is, again, Warren Buffett says, that once you've got a good quality company, you just got to wait. You just got to wait. Now, we tend to hold for 12 months and then reevaluate, okay, as well. Yes, Alan, the stronger dollar is helping UK companies. That's why their profits have fallen and their sales have fallen, but their valuations have gone up because what's happened is that on a technical accounting point, because they earn, FTSE 100 companies earn a lot of profits in the US, for now anyway, when the accountants every 6 months convert that into sterling, it looks like they've made more profits than they have in the UK or in sterling terms, because they're not really transferring that money across. So you could argue it's a technical point, you could argue it's an accountancy thing which inflates the price of FTSE companies. Either way, it doesn't really matter. But yeah, that's why we've got an all-time high. We haven't got an all-time high because of economic growth in the UK. It's because the dollar has got stronger, that UK companies have got an all-time high on the FTSE, which is fine because we're only bothered about making money anyway. So I'll come to the FTSE in a second. But yeah, thank you, Donald Trump, for making the FTSE at an all-time high. It's thanks to him that it's at an all-time high, which seems perverse and ironic. Because he's not got credit for that, and he's very good at taking credit, but he hasn't taken credit for it yet. Although I'm sure somebody's going to whisper it in his ear. Maybe you could email him and tweet him or something, and on Truth Social, and say, "Listen, mate, it's thanks to you we've got an all-time high in our stock market." Ironically, the last time we had a surge in the FTSE 100 was when Liz Truss, I'm not allowed to say it anymore, that she crashed the economy, am I? When sterling plunged to 1.09 to the dollar. And of course, FTSE stocks went up because the dollar rose strongly against the pound. The pound plunged as well. So, which again shows you poor economy domestically crashes the pound, but the stock market rises. And in that year, because bonds prices fell and a lot of pension funds hold bonds, when they looked at their bonds on their balance sheet, as you'll remember, some of these pension funds lost 20% of their value. So your pension didn't suddenly make lots of money, because if it didn't hold equities but it was holding bonds, which many pensions do, so especially if you're closer to retirement, you just found you lost 20% of your money in a year as well. I'll show you the newspaper article of that in a second. So one of the ways in which we make money for clients is we actually teach them this, which is sit on your hands a lot longer than they think, and we show them why and when. Okay, so let's look at the FTSE 350 risers. Okay, these are the risers over the past month. These buggers have been doing a lot of advertising. So they've been rising, well, albeit they'd fallen previously, which is good news for me, because after about 12 months, when they've had a surge of new clients, and those clients after 12 months get dissatisfied, we get them joining the Great Investments Program. So in a perverse way, I actually want St. James's Place to take on more clients, because they can show them how rubbish they are, and then they come to me, which is great. So we'll move on to the S&P. Now, this is the S&P. Okay, just so people understand what this measures, this is called the moving average convergence divergence. All it does is this: it looks at the longer term average of a stock or a security, and let's say the long term average price of something is $100, for argument's sake. Okay, and what it's saying is, if in the short term it gets too far away from its long term average, it might pull back and revert to mean. Okay, revert back to its average. I've really simplified that a lot, and that's all it's measuring. So what it's saying is, if you take that, okay, if it goes too far away from its long-term average, it'll probably pull back, as it did here, for instance, and give an indication the price is going to fall. And then if it moves too far to the downside, it'll probably rise up. Now, it's not an ironcast law. If it was guaranteed, you and I, everybody on this webinar, we would all be sitting on a beach in Bali, owning the island that we're on our private yacht as well, off the coast, etc., etc. It's not ironclad, but it's just to help us see divergences. As prices tend, companies, securities tend to grow at a certain rate, and if they get too far from that rate, they tend to pull back. So it's another way of saying things have got too far away from valuation and growth, and they're now trading more on momentum, so they might pull back. A mean reversion is actually a popular hedge fund strategy as well. Anyway, all I'm saying is you can also use it for pattern recognition. It's a bit overbought. There's nothing for me to do. I own, as you will know if you follow my webinars, 1x S&P tracker, 2x leverage, and 3x. And I'll come to those in a second. Don't do leverage, any of you, because you shouldn't. Your retail clients don't touch leverage. It's fine for me. In other words, when the S&P from 2023 goes up from this to that, which is what, nearly 100% gain, my 3 times leverage makes 300%. Did I know it was going to go up that much? No, I didn't. Okay. 2 times leverage I only started in November just to show clients what that looks like, and it's a lot less volatile. And I never do more than 3 times. Well, I never do 3 times leverage in it, except in the S&P and NASDAQ. Now, we'll ignore leverage for a moment. Okay, just imagine what the index is doing. Now, there's nothing for me to do at the moment with this index. Would I buy it today? Well, here's how you simplify decision making, anything complex. You've got, let's say you don't own this. Okay, you've only got one decision to make. Do you buy or not to buy, right? If you don't already own the index tracker. Now, if you are risk loving, you don't mind that it's overbought, which means it's in the top half of this or top third of this graph and could fall because you're risk loving. So you would buy. If you are risk averse, then you certainly wouldn't go anywhere near anything overbought because you're risk averse, obviously. So you wouldn't buy it. If you're in the middle, which is risk neutral, you'd probably toe dip in, or what Warren Buffett says is you never test the water with both feet. In other words, you'd add to winners. You might put in a third of whatever your allocation is to an individual security. Let's say you divide your money into 20 equal lots, i.e. 5% in each, and you're going to put, say, $10,000 into an individual security. You might put a 3,000 in this month, and if it's up next month, you might add to it again and up the month after. That's called adding to winners, popular with hedge funds. Dollar cost averaging, popular with retail funds. But either way, the point is you're gradually going in, which is a more moderate activity. What's the right answer? You'd only ever know in hindsight because we can't see into the future. So pretty useless asking what the right answer is. The only thing to ask is what's your risk appetite and suit it and fix it to that, right? So as I say, I've told you what I've done and I've told you what you would do based on your risk appetite. Simple. S&P, this is the daily. Each one of these are the daily prices. Now, I'd probably say, given that both of these are moving lower, the weekly and the monthly, that we're probably going to head a bit lower for the next few days. I mean, there's certainly downward pressure. That is not happening anytime soon. Maybe we'll be locked in a channel here for a while until the next set of earnings 3 months from now. Maybe. Okay, it doesn't look like, from looking at these, that we're suddenly about to get a move up. The downside looks in the near term more likely than the upside. Bottom line, there's nothing for me to do because it isn't a daddy bear. A daddy bear is where it crosses below and there is a proper mean reversion, as happened in 2022 when I had to say to clients, well, I'm holding cash. And when that fell, we were holding cash. We didn't know it was going to fall the whole year. Each month we looked at it and said, nah. Okay. And managed to save ourselves a lot of money, which was kept dry powder for when it went up because then it started rising. Fantastic. Okay. Very simple. The NASDAQ 100, same story. I've got 3 times leverage and regular on this. I should say that's my son, if you watch my YouTube or TikTok videos. Okay. And if you haven't, that's my YouTube channel. You can see some of the TV stuff. There's a whole bunch of videos on why people's performance. And what I've also done in there, I've also gone into specific funds and why they've lost their edge, like Fundsmith, Fidelity, and so on. My YouTube channels over there, and a whole bunch of TV appearances. Stuff I've done with Investors Chronicle, which is part of the Financial Times. Obviously, BBC, CNN, all the rest of it as well. So there's a whole bunch of and GB News. I'm dressed as a vampire there. I was at my son's Halloween party and they said, no, we need you on air. What do you think about Rishi Sunak as Prime Minister? So that's going back a bit on GB. And I was dressed as a vampire. And I said, it's bloody terrible news. I've got my mother-in-law and my son both asking, why aren't you Prime Minister if he can do it? Anyway, there's a whole bunch of stuff you can see there. So on the individual as well. Now, what do I do with this? Well, I'm still holding it. So you'll know my son has NASDAQ tracker and 3 times leverage. So I take higher risk on his, not through more volatile, risky companies, but actually through leverage on funds, because funds are low volatility. So if I leverage low volatility, I'm still not taking more risk. Okay. And he's doing well. He's about to turn 7. And the little bugger's certainly got more money than I had when he was. He's got more money now than I had when I was 18, 21, 25. I think he's got more money than I had when I was even, certainly 25 anyway. there we go. So that's where we are with that. Would I buy it today? If risk loving, yes. If risk averse, no. If risk neutral, very slowly and cautiously. Okay, FTSE 100, there's your all-time high. It's well, I say all-time high. I mean, it's not much far off 2019 levels. You know, piss poor compared to obviously the S&P and the Nasdaq, which have absolutely trounced it, as they do in any rolling 12-month period. I think there's far greater probability, but let alone over 3-year rolling periods, since the Second World War, since 1980, since whenever, particularly since 1997, 98. I think you hardly ever find a year where I think perhaps the financial crisis was the only year, just about. Anyway, but that's where we are with that. I wouldn't have a problem. I mean, look, let me put it about diversification. Pension funds are obsessed, if you're British, of investing in UK securities. I don't know why, because you're already concentrated. You know, this is for diversification. We got global and UK. You should have nothing in the UK if you want diversification, because you're already committed to the cost of living costs here, the economic costs, the laws, the economy, your wages, your salary, your pension, the taxes on your pension. You've got a concentration of risk in the UK because you live here. You're subject to its laws and expenses and everything else. Diversification, the first thing they should do is say, actually, we better get you stuff out elsewhere. That's diversification, but they don't do that. Anyway, well, partly because they don't understand what the hell diversification is anyway. They don't understand that when markets fall, they're correlated to the downside. I wrote about that in a Financial Times column over 25 years ago from academic research which had been done. So when the markets fall, you're not going to get the diversification you think you're going to get because correlation increases. And when markets rise, you don't want diversification, you want concentration because they're rising, because diversification would imply you want some things to fall. Why the hell would you want things to fall when markets are rising? So they really don't get it, which is why concentration is what the billionaires have in their portfolios. Because there's very few quality companies with low volatility and high upside. That's one reason to concentrate on them anyway. I remember if we were reading, thanks, Sean. 2 times leverage. Now that's just for me, it's leverage. I don't have a problem with it being overbought. And yes, by the way, the 3 times I had since 2023, as you'll know if you follow my YouTube and stuff, but the 2 times I've only had since November, just because I wanted to show some of the clients how that looks in real time. Top 10 S&P 500 stocks over the past month. Let's have a look at some of these, and then let's look at Amazon, Alphabet, Meta, and all of that, some of those as well. Okay, so on my value growth income, this is an 8, CVS. So over the last month, this is up 23% in the past month. It had one hell of a fall. It's volatile. It's now up here. That doesn't mean it's going to do this. What this means is what my team gets, I tell them to put the most optimistic best case scenario, which is a growth rate similar to one it's had before. Okay, so this is not a recommendation. It doesn't necessarily mean this is going to go up and this is suddenly going to break through. We're just looking at where the massive gains have come from recently. So undervalued, high growth by the looks of it, and there is some momentum, but a bit too early for me, I would say. Okay, and also way too volatile. I don't like that. That 31% drop there mimicked here as well. Ugh, don't want it. Even if it were to go from 56 to 91, which it may well do. No, I don't like the volatility. That's an important point. Your risk appetite is based upon what's called drawdown danger. Drawdown danger equals the depth of a fall times its duration. Okay, write it down. DDD equals D times D. What the hell does that mean? Drawdown is the depth of a fall and the duration to make the money back. Okay, if you're risk averse, you want this. If you're more risk loving, you don't mind this. Okay, that's what it is. Now you've got to work out which one of these you are. Well, what's the upside and the downside of looking at things like that? Well, the downside isn't that if you do this, you're going to get more returns. That's what you've been told. More risk equals more returns. If you cross the road with your eyes closed, that's more risk. Does that mean you've got better at crossing the road? No. What it means, you've got less choice if you want that, but that's fine because you only need 20 securities. And that's, again, something which your average typical IFA doesn't understand. Let me give you a few other things. If you've got an IFA, ask them 2022 what performance they got, and ask them what the Sortino is, and ask them why you can never speak to the fund manager. You'll never be allowed to speak to a fund manager, ever. Okay, 3 questions to embarrass them. Oh, also ask them, the exams they took, were they multiple choice? Okay, 4 things to embarrass them. Now, Constellation Energy, one of the big movers. How does it look at the moment? Well, if it were to continue on that trend, that's the upside. If somebody put a gun to my head and said, I want you to give me an investment strategy for this, Alpesh, it's not one of our value growth income 7, 8, 9, or 10. Okay, and if they said, I'm going to put a gun to your head, give me it, I'd say, well, if that's the 141 projection, I'd probably put a stop loss there. Make sure that the upside over 12 months is more than twice the downside if that's the stop loss, because if it's going to rise, it shouldn't go there. And it looks like it is, because that looks more like a 30% drop, 40% drop, stop loss, and that looks 141 to the upside, if you agree with that analysis. So multiple upside to downside, there's your stop. And if it were to drop down there, you shouldn't lose more than 1% of your capital if that happens, and that's how you decide how much money to put in. So there's your money management, your risk management, and your investment structure right there, if you put a gun to my head. I'm not interested in this one, by the way, because it doesn't have my value growth income. But as I said, if you said to me, you've got to create one. Starbucks, also one of these. So just in case you're wondering where am I getting these names from, it's the ones which have moved over the last month. So just out of interest, putting those on. Starbucks, that'd be the most optimistic. You might disagree with that. If you disagree with it, don't do it. And you'd probably put a stop loss just around there. And you've got to make sure that that drop is at least half of that. Now, you might say, it's not for me, Alpesh. Thank you very much. I see your analysis. I don't like Starbucks. I don't think coffee is going to be the way to go, not with all these tariffs and everything else. Fine. If in doubt, leave it out. You might not like the fact that it goes sideways a lot. You might not like the drawdown danger and depth, the drawdowns in an upward trend, because if this upward trend would continue, these drawdowns, and the duration, in which case not for you. That's why we have to go through 10,000 stocks, because we're being really, really picky. 7 on value growth income. Okay, because I have an algorithm which works out the valuation, the growth, the income. Okay, can you please advise on Atos Origin, the IT company? I'll have a look later when we do the Q&A at the end. International Business Machines, they've been shooting through recently. Okay, so that'd be the projection. You'd probably want to put a stop just there. Okay, so there's your downside, there's your upside. Is the reward to risk worth it? That's overbought, high risk. If you're risk averse, you would never do something where the momentum is that high, because you're risk averse. If you're risk loving, you don't care. And if you're risk neutral, you would add to winners, and you'd probably put the stop there. And so you know what your upside is, you know what your downside is. You put it into a little Excel spreadsheet, you monitor it once a fortnight on your broker's platform, and you go, yep, nothing to worry about. Boom. Okay. GE Aerospace, similar kind of story, overbought. These are not my picks. I'm just showing you what's gone up. And if you put a gun to my head, how you would put the thing. These are not official picks from the Great Investments Program or anything. Okay. Before anybody thinks, oh my God, he's telling everybody on what selections that we have on the program. 60% is the direction there. You probably put a stop there. 2 to 1, all the rest of it. Risk loving, you would not have a problem. Risk averse, you wouldn't go near it. It's not a special situation. It's not 7, 8, 9, or 10 on the Great Investments Program data, and for that reason, you wouldn't want to do it. Okay, so that being the case, I'm going to show you something else. That's why I say 20 to 40 stocks, because after that, you've eliminated company-specific risk. Have less. If you've got one stock, you've got a lot of company-specific risk. If you've got 400, and what do most funds have? They have about 100 stocks in there. They spray and pray. Okay, and ask your IFA, why did you give me a fund with 100 stocks in it? If the fund manager is any good, why does he need a bloody 100 companies to spray and pray on? Why can't he just do what Warren Buffett does and have most of his money in the top 5 holdings? Ask them. They won't have an answer. Okay, and then come back to me and say, bloody hell, Alpesh, how did you know what those idiots were going to say? All right. Now, I'm going to show you something else in a second. I've got to just make sure I don't disclose too much. Let me give you an idea of what I mean by companies which are not suitable. None of these, okay, are all green here. So imagine how many companies we have to say no to. Not any of these. Sorry, could somebody look up the Leeds United score for me, please? Okay, I'm either going to get very happy or very sad. Thank you. There we go. I should say, can somebody look at what the stock market's doing? Just tell me the Leeds United score. See, none of these fit. We then filter the ones which are, which obviously I can't show you. And we also break it down by the other filters as well. So you see how much you're getting rid of, because quality is key. Now, if this were to go up on momentum and continue up here and give you your 35%, and you put a stop there, you could see how it would work, but it's not a 7, 8, or 9, so it's not one for us. Costco, not one I own at the moment. It's one I've owned in the past. It'll be one that I'll own in the future. Why? Well, because it tends to give these long periods of gains. Why don't I own it at the moment? Because I can't buy everything. Okay? I can't buy everything. Apple, I do own it. Clients will get my analysis. Amazon, you all know I still own it. Microsoft, you all know I still own it. Meta, you all know I still own it. Bank of America, I don't own, but I've been covering since it was down here. And in hindsight, I guess, instead of just covering it, I should have bought it as well, but I can't buy everything because I dilute my holdings too much. It's an 8, but it's overbought. And that's the direction. Now, why do I cover it every single week? Well, to show you how this approach works, to show you how this approach works, to show you, I guess, to show off. Look, here's ones I didn't even buy because we're so good. We make money. No, it's not that. It's just to give you a broad market update. So that's banking, not just tech. Netflix is another one I don't own. And it was since here, and it was to show you that even after a deep move and then a rise up, that actually got ample time to make money. You know, this notion that, oh no, I missed it. Did I miss the opportunity? I didn't get in there. 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 You get a whole group of people who go, oh, I missed it. I missed it. I missed it. And they sit on the side of the railway going, I missed the train. I missed the train. I missed the train. And 10 other trains go past and they're still sat there going, I missed the train. I missed the train. I missed the train. Humans are like that. You know, sometimes when I throw them on the track and put them out of there and my misery. Netflix. Okay, so whilst it's a 7, it's overbought. So you know what I said, risk loving, you don't care. Risk averse, you wouldn't do it. Risk neutral, add to winners, probably put a stop there. All right, Walmart, not one I own at the moment, just so you know, will be one I'll own in the future, but not right now. Can't buy everything, and it's been doing. Why will I buy it in the future at some point? Well, because that's how it performs for prolonged periods. Okay, and at the moment, bloody hell. And in hindsight, yes, I wish I had bought it, but I can't buy everything. So yeah, I do have a lot of, you know, it's like you can't marry every woman. Some of us try, but it's the same thing. Never marry your stocks anyway. Walt Disney is at a near, what is that? Near 3-year high. But it's bloody volatile. And although it's an 8 and that looks like it's going up, I'd say just leave it, because trust me, you don't want that 30% drop. Okay, that's volatility that people don't want to handle. Okay, and first time round with this, when we first mentioned it, when it was around 82 and it shot up and then dropped all the way back down, I realized quickly, you know what, with volatile companies which have had prolonged periods like this or have these kinds of drawdowns, don't even bother mentioning it to people because most can't take that kind of volatility. Now, anyway, it's back to its 3-year highs. That's the most optimistic assessment. You might disagree with that, and I guess you'd put a stop loss just there if you want to get your hands on some of that, but not for me, not for any of you. It's too volatile. Don't even bother. Why would you mess with it? It's too volatile for you. If you already own it, keep hold of it. That was last year's performance, okay, from a January broadcast. Now, if we do the February broadcast 12 months on, it'll be different, okay? If we did March to March, I'm sure it'll be different. We do January to January. It was from the January 11th broadcast, the filtered list, okay, that we produced. And those were some of the returns. Now, why was it so high? Did I think it was going to be that high? No. Did I know MicroStrategy was going to do 515%? No, because if I did, I would have just said, hey, buy that and leverage it, or just buy that. Did I know what this company did? No, no idea. Okay. So the point I would make with all of that is, as I showed you earlier, you could have 8 months of zero. The biggest component to that doing well is that the market went up. Okay, the market went up 25, 30%. If it went down 20%, like in 2022, at one point it went down, we would get 0%. So the biggest component to stock success is not value, growth, income, cash flow, Sortina, all the things that I showed you. It's actually what the market's doing because of the high correlation to the market itself. That shouldn't come as a surprise. I can't create companies to go up in a down market if those companies don't exist. I'm riding the coattails of what other people have created. If they've created NVIDIA and it's a year when everything's falling, I can't force it to go up. People have this crazy notion that Alpesh is going to find a company which he's going to invent and pluck out of thin air and say, look, this one will go up if everything else falls. You know, here's a nuclear holocaust, but you will survive. No, it doesn't work like that. Okay, we don't have to be smarter than the rest. We have to be more disciplined than the rest. It's that simple. Save time, process, discipline. This is it. My data team produce all this data. The graphics team put the charts together. Bang, that's the process. Saves so much time having those people do it. Okay, and then clients get them basically working for them and producing it. And then all the client has to do is work out the volatility to suit their risk appetite. If they're risk averse, volatility under 10%. If they're more risk neutral, volatility under 20%. If they're risk loving, don't care about volatility, obviously by definition. Boom, that's it. Job done. Go away. Go smell the roses. Go play with your kids. Go focus on your business. We also give them an entry checklist. This is the entry checklist. Why? Well, it's just simpler if they do all of that, you know, and check it off. It's resulted in some very happy people, as you can imagine. We have a little wall of love. If you want to add to that, it's there. Let's look at a few more. Oh, this is a photo from today. That's Asif Rangoonwala. Asif was the first investor in my hedge fund, 2004. We set up a Cayman equity long-short fund, domiciled out of the Cayman Islands, UK asset management company, Irish Stock Exchange listing. I won't go into sort of the technical reasons why. The reason I want to mention that is today I saw the picture. He's been awarded the CBE, not for his investment acumen in my company. It took 10 minutes for him to invest in me. He took the presentation that we had, a PowerPoint presentation, and he said, flung it back at me. I remember South Audley Street, where his offices were, for Euro Buns, largest frozen bun seller in Europe. And he said, I don't need the presentation. I'm investing in you. What a legend. Anyway, thanks to him and a couple of others, we got off the ground. That was 2004, and the rest is history, as they say. Goldman Sachs, US equities have significantly outperformed since trough of the financial crisis. Who's done best? Annualized total return, 16 and a bit. Then you've got India, non-developed, Eurozone, emerging markets. I don't gamble on countries. I think if I just even focus on that, I've got enough choice. Okay, as well. Matt, sorry, just was it not clear? So that's 41.52. Those were some of the best performers. Okay. Oh, if I were to take out the NASDAQ and that, the numbers don't change much. It comes to about 38. And the reason is because these weren't the only holdings. There were a whole bunch of others. There were 29 in total, of which, by the way, out of interest, 5 were negative returns. That's why this 41% total return, and we assume that all of it invested equally. We assume that 41%, the reason that 41% is there and not 515 is because we didn't just pick one company. There were 29. 5 were negative returns. 5. It's 1 in 6 was down, even in an up year. See, despite all that analysis. If you take out the leverage ones, the 2 leverage ones there, then you end up with about 38%, just because 129. If you take out 229 of that, and given how well these others did, it didn't make much difference mathematically, because we did that and we looked at it and thought, oh, that's interesting. Okay, so that's that. S&P 500, a positive January is usually a good signal for the rest of the year. We've had a positive January. The S&P 500 performs for the year based on if January is higher. 16.8% is the return if you get a positive January, so, which, funnily enough, is almost exactly the S&P 500 return. So if we get another 16.8% this year, we got 25 last year and 30 the year before in the S&P, then obviously our stock portfolio should do rather well. But I guarantee you one thing, there'll be like 8 months where we'll have 0% return. Why do I guarantee that? Because it's a lot easier to guarantee the downside than the upside. Never guarantee the upside, always guarantee the downside. I'll give you an example. In 2021, Microsoft generated a 50% return in 2021. It was 50 or 48, something like that. Okay, for 9 of the 12 months, it was negative or flat, 0 to negative returns, 9 out of 12 months. But it was up 50%. Okay? That's the bit that people don't get, and they just can't get their head around it. Which markets, economy, regions provide the best long-term investment opportunity. According to Goldman Sachs research, in 2025, they're coming up with India. That doesn't mean I go and buy a load of India ETFs. I've got to look at it. I've got to look at it based on, I'll just show you how we do ETFs. Whoops. Oh, I've done that wrong. Let me just show you the ETFs. Let me just show you the ETFs. Okay. Right. We need the ETFs all to be green as well. All of this to be green. Okay. And so we go through, guess what? 7,000 ETFs. 7,000 exchange traded funds. Now, out of that, I might try and look for India. Okay. Oops. Sorry, on this, I can't always do that. There we go. Okay, so let's say we get the Amundi India. Problem I've got with that at the moment is, other than the fact that, as many of you will know, maybe a bit expensive, the market, volatility is okay, Sortino's okay, the alpha's not great. In other words, its ability to outperform the market, and it's already dropped 17% from its high, so not particularly as excited as others might be regarding that. Probably better might be Japan still. Anyway, what else? Future mobility, sorry, Europe value might be worth looking at as well. Interestingly, Europe, not quite there. World stock market returns. Let's just have a look at what the 10-year annualized return is. So it's local in sterling, it's 15.6% over the last 10 years on the S&P. In local US dollars, it's 13.1. Portfolio, I think, refers to their own one, so I'll ignore that for the moment. The topics, blah blah blah. FTSE All Share has got you 6.2%. Okay, so basically I'm making twice as much as you if I just match the index. And if I'm making twice as much as you per annum, guess what that works out over 10 years? You're poor, I'm not. My first column in the Financial Times, 1999, I'm selling all my UK holdings and buying only US ones. I'll show you the column in a second. That's 25 years. Bloody hell. UK pensioners have been screwed by the UK pensions industry because people just refused to buy, because they could, but they just never did, things outside of UK. Thanks for your patriotism, but you're going to fall on this estate, unfortunately. And nobody highlights the scam. Because you can buy US equities. And you make double the money, and people say, "Yeah, what about the currency risk?" Shit, really? 44% versus 0, and you're worried about the currency risk? And how's that worked out for you on the currency risk, by the way? Dollar surges, pound crashes, and you kept holding the crashing pound. I want British people to be rich, and that doesn't mean that they can only buy British, which is why sort of nationalism in pension funds is a bit stupid. It'll end up poorer. £5,000 investment with or without income reinvested. I thought this was interesting from JP Morgan Asset Management, without dividends reinvested, with dividends reinvested. Now, when we look at performance, we've not looked at dividend reinvested, so ours looks even better if you think about dividend reinvestment. But anyway, I just thought from their wealth management, that's good. Wealth allocation, the top 1% was in the bottom 50%. The bottom 50%, this is from Goldman Sachs and the Federal Reserve Board in the US. What they've discovered is that the bottom 50%, which is about $7 trillion of people, is largely in real estate. Okay, the top 1%, 35 trillion, is in equities. Okay. Oh, another little update. 2.4 million views now achieved on February the 2nd, 2025 on YouTube. So if you're not on the YouTube channel, please do have a look. I got this lovely one. Now, Palantir, I didn't buy. I bought this in 2022, a few months after your special situation. I did a special situation in 2022 where I said to people, hold it for 3 years. I can't buy everything. So when I posted it on the private Telegram channel, I did. And I got this email last night, about this time last night, actually. And he said, thank you, basically. Thank you for especially you posted as the market for very hard to track. So it's lovely when people tell me, because I don't know. I can't monitor if they've done it. Anyway, watch out for this. I used to lecture as a visiting fellow at Corpus Christi College, Oxford. I used to lecture on behavioral finance. And if I had to pick one simple thing that's not me in 2020, that's not me from when I was lecturing there. I was a lot younger than that. I was 29, I was 30 years old when I was a fellow. confirmation bias. And you see this on Twitter and stuff, but you see it in investing. I've taken that from Daniel Kahneman, who, as I said, got the Nobel Prize in economics. He got the Nobel Prize in economics at the same time I was doing my lectures on behavioral finance on his work at Oxford and writing about him in the Financial Times. And it was very exciting because he was the first non-economist to get the Nobel Prize in economics. And Daniel Kahneman, one of the things that he discovered was this whole confirmation bias, which is why a lot of people make stupid money mistakes. So just be aware of that, looking for stuff which confirms your own pre-existing biases. Biggest funds in the doghouse. Just watch out if you've got any of these. It's not just the individual fund. It's usually the provider is providing a whole bunch of funds which are rubbish. So if you St. James Place, Fidelity, 91, just be careful in terms of how poorly they're performing against the benchmark, the relative performance compared to the benchmark. Okay, I think I took this as a snippet from the Daily Mail. I think it was the Daily Mail. It was one of the newspapers. Okay, so it's very worrying how they're just screwing over British pension fund owners. This is the 3-year underperformance, 10 biggest underperformers by size. These are the names which commonly come up as the major culprits who are screwing you over. My life's mission through my 18 books, my Financial Times columns, everything else has been getting people to use their SIPs. But government gave you SIPs. They don't often give you a tax avoidance mechanism. Okay, it is tax avoidance, the SIP. So is the ISA. I want you to bloody use it to buy stocks yourself instead of making these buggers rich. Okay, because the gap between what they provide and you just even tracking a bloody index is so wide. So, and the poverty gap between US and UK is going to get wider. That's the US, that's the US, that's the UK over the last 10 years. And you might say, well, it's just over 10 years. We're going to narrow the gap now. Seriously? We're going to narrow the gap all of a sudden, you think? No, that gap's going to get wider. There's a few things I'll guarantee. I'll guarantee you in the next 10 years that that gap is getting wider, my friends, and a lot wider. Underperformance. So what have you said? If I end the poll, what have you said? Underperformance, and then fees, not trustworthy, lack of transparency. Well, one of the things that we like to do is give you all this data. We give you the data if you're on the Great Investments Program anyway, so you can understand exactly why and what to do. Okay. If you've got $250,000, now let's say you've got 100,000, you do 10% better in just 1 year, thanks to our help. Just 1 year, then that's £10,000 more. Got $250,000, that's £25,000 more. Got $1 million, that's 100,000 times better, and that's just in 1 year. If you happen to just then mimic rubbishness of everyone else for the rest of the 10 years, at least you've still got your 100 grand you're compounding. Another great one. We've had quite a few. Method of teaching and mentoring, good. I'm glad. Thank you. 65% over 2 years. I can't really take credit for it. We put the opportunities in front of people, give them the data. That, like a school teacher, the student then has to actually pull the trigger and execute, and they do. This is from This Is Money. Has your pension lost a fifth of its value this year? Real lottery of returns in work retirement plans. Just please check your pension. Just check what it's doing. Stop letting these people charge you fees and you ignoring it. This is from the Financial Times. Give workers power to ditch pension schemes. UK regulator in call to reform workplace retirement. Saying workplace pensions are some of the worst because they always put you into default schemes. And the default schemes invariably generate very little return. Why? Well, what would happen if they generated excessive returns? You might retire early, pull your money, go spend it. They need you on the drip, okay? The hospital drip in intensive care where you're earning 6%, so they can keep taking fees off your capital every single bloody year, okay? The two worst things that can happen for an IFA or a wealth manager is they do incredibly well because the employer is suddenly going to ditch the bloody pension fund manager and say, you bugger, I've just had a load of people retiring early, because you just doubled their pension in 4 years. Now they've all bloody retired, taken early retirement, gone and spend the money, and they pull their money out and go spend it. What happens? You're not earning the fees. You need to keep them going. It's just pissing me off. Pensioners, why do those retiring face massive losses despite FTSE highs? That's from The Guardian. Okay, you can Google this article on The Guardian, put those terms in. and it'll give you the whole article, because the Guardian don't charge you to read it, so you can read it for free. Retire plan, I was shocked to see Aviva pension drop 20% in a year. Hang on, how can it drop 20? How can a pension drop 20% a year when you're with an expert like Aviva? And how come it's so bad that the Guardian has to cover it? Like the post office scandal. You're going to keep reading about these in the press until somebody at the ITV does a documentary and says, shit, this isn't just Alpesh talking about it on a webinar or in his financial columns from 25 years ago on his Bloomberg TV show. Shit, somebody should do something about this scandal. It's like Britain's riddled with scandals. Why did they lose 20%? Because they hold a load of bonds and the VAT price of bonds fell. Well, didn't know bonds could fall in price. Didn't they know what they were doing? Did Liz Truss know what she was doing? Did anybody? No. Nobody bloody knew what the F they were doing. 20% your pension got. No. Hey, guess what? Guess what's interesting? Like with the financial crisis, nobody gets to go to prison. It's incredible. That's the Guardian reporting it. Telegraph, you can look at this. Have British fund managers become a pointless expense for investors? It's not me saying it. Telegraph, worst fund managers take $500 million in fees from investors. Not me saying it. Telegraph, go look it up. Okay. So it's really low-hanging fruit and very easy for me to win. It's really easy for me to win because look at how crap my competition is. Just look at how crap the competition is. It's not because I can pick better stocks. That's not what it is. It's that they're institutionally handcuffed to, they're only allowed in each fund to pick from a narrow geography. So they can only be value stocks or growth stocks or income stocks. Well, I can pick value, growth, income, and I can pick from any of the 10,000 UK, US, European stocks that can go in my SIPP or ISA. So I've got a natural advantage. So in a way, by criticizing them, it's a bit unfair. They're handcuffed. Did anybody tell me the Leeds United score, by the way? You are kidding me, Michael. Are you having a laugh, son? Leeds winning 2-0. Right, Michael, I'm taking you off, mate. I'm taking Michael off. Thank you, Gary and Peter. What is wrong with you, Michael? Don't play with a man like that. 2-0. That's the well. I've written many of these articles. Everything that I'm telling you has been published in the Financial Times. There is nothing I'm telling you which has not been published and peer reviewed. Okay, this is not some internet conspiracy theorist who killed JFK. This is my son's junior ISA. This is not what he holds at the moment. He does still have Apple. He still has that, but he doesn't have these two at the moment. But that's that. I'm showing you this to show you because it's a child's ISA. He'll have fewer stocks because he doesn't have a lot of money because you can't put much in it. At that time, when he was born, you could only put 4K in a children's ISA. Okay, now I think it's closer to 12. So the point is, the way I concentrate risk in his is I make sure he's got a few stocks, some leverage, but with low volatility that I watch. How do I watch them? I do a webinar each week. This webinar. That's why I'm watching his portfolio. I know what's going on in it. Okay. This is another good one. What did I get? Joined in 2021, only started in 2021, 100K to 400. Now, that's not because by osmosis he suddenly went fourfold up. It's because he actually did do something. So I love it. I love students like this. He managed to have 2 babies in the past 3 years as well. God bless him. So there we go. I have a lot of business owners, but a lot of people who are also retirees, as I said, professionals. I guess they're the major categories as well. Okay, now you got to, I think, look, you can pick stocks any way you want. You can pick exchange traded funds any way you want. If you're lower risk, pick exchange traded funds, okay, because they're lower volatility. 7,000 to choose from. If you're medium to higher risk, you got the whole universe open to you, okay? You need to find a process where it's value, growth, income, cash flow. Otherwise, you're going to Vegas with your hard-earned money. Now, private investors do this. Retail clients naturally are less professional than professional investors, obviously, and they take more risk. It's incredible. They will, flying blind without all the information, risk their life savings and their pension and their future. It is nuts. It is crazy. This is from Goldman Sachs Wealth Management, okay? I think this is too conservative, but depending on your years to retirement, if you've got 25, as my wife tells me I have, you might have more equities. Fixed income, bank account interest. Okay, you should be able to get about 4.4% at the moment, 4.5, 4.6, 4.7 at a push. Possibly. I mean, if anybody wants to share where they're getting more interest, let me know, because sometimes you guys know more than I do about bank accounts. Okay, and then you got a more or less there. Okay, so I just thought I'd share that with you as well. 20 to 40, they're ample. You don't want to take too much concentration. Again, everything that I've said has been published in books. I'll make sure you're all given a copy of one of my books for being on here. Where is it? Investing Unplugged. Everything I've said is in that book, and that was published by Macmillan. Also, there's a ton of free stuff. If you'd like a schedule a call or free investing course or free copy of the books, all sorts of stuff is on there. alpeshpatel.com/links. I want to show you a few other things. Okay. What I also tend to do is then, I don't think I've got a monopoly on knowledge. So we'll cross-refer what I've got on my Excel with also what is on the biggest hedge funds, what the biggest hedge funds are doing as well. Okay. And what that then does is it allows us to cross-reference and see how companies are performing ours with theirs. So this one's got 53% per annum for the last 3 years. And we will look to see what they own and whether it meets our filters. It just gives us an extra degree of comfort. We're not the only ones to get things right. So it's something I like doing. This was back in 2020, because I don't want to show all the latest stuff because people might think it's a solicitation to buy. We'll look at what they've added, and then we'll see if it meets ours, and then we'll cross-reference it with all of these hedge funds and see if any of them are generating more than 40% per annum for at least the last 3 years, so they're not one-hit wonder. And that gives us a degree of safety as well. HubSpot, similar kind of thing. Stock HubSpot, I bought in October for one of your hedge fund picks because it hit our filter, and it was one of the ones from the hedge funds, returned over 40% up to now. It doesn't happen every time. It's great when it does. That's the goal of it. And the prize, this is the prize. That's what we're looking at. It's very simple. Like any other business, we've got a goal and a KPI. How close are we to this end? We can't guarantee it. How close are we? In any given year, like in 2022, we were over here, 0%. And if every year from now till ever will be like 2022, we'll never make money ever again. But thankfully, the markets aren't like that. Okay. In fact, what I'll guarantee is over the next 2 years, we'll get 32%. Why am I guaranteeing that? Because actually, that's the long-term average. 88.5% of the time, the average positive return is 32%. Okay. So over 2 years, So I'll just guarantee that. Why am I guaranteeing that? Well, because I'm just playing statistics. It's the safest thing to do. My job is actually not this bit. The market takes care of this bit. My job is this bit. My job is to make sure that we don't have the big falls. And how we do that is pretty straightforward. The way we do that is what I call the daddy bear, which I showed you earlier with the S&P. Okay. These things, I get these emails all the time. When I get them, it's of course a delight, but again, it's not me doing it. There's a market tailwind and we just followed a procedure. It's a bit like, oh my God, doctor, you gave me paracetamol and my headache went away. Yeah, I can't really take credit for that because the paracetamol did the hard work and you took it. But hey, I'll take credit for it. You can see some video interviews there with people and how they found it. It really works best if it's people who, as I said, they might be time poor and cash rich, but they want somebody, or rather they want a team to have collected the data and present it and then educate them. I think anyone can do it. That's been my principle, because all you do is open a SIP. It could be Barclays, could be anybody else online. That's all it is. It's a SIP. It's a bank account, which is like that. And that's it. And then you can buy Microsoft or whatever else. This is the major problem. Don't buy on name recognition. Scottish Mortgage Investment Trust lost you 50% of your money in 1 year. 50% in 1 year. Can you believe it? Could somebody explain to me how you lose 50% of your money in 1 year? Okay, that's a professional fund manager. Absolutely can't stand them. This, by the way, all the returns are on the website. This was 54% in 2020-21. Why? Because the market had a great year. These are just some of the best performers of that year. Doubtless there were ones which went down as well, but on average, the total average, you average all of the ones, that was it. This was 2023, the year before last. Why? Well, because the market was, 2022 was zero, by the way. It's slightly more than zero, but I call it zero, because we had to hold cash. Okay, it was 80. That's not because of us. It's because that bugger went up, and that went up, and that went up, and that went up, and so on and so forth. There were others, and some went lower. I think there was one which actually lost money, even in a year like 2023, where the Nasdaq went up 55%. Okay. And at that time, by the way, in that January list, I hadn't mentioned leverage, so we haven't got any leverage in there. We hadn't mentioned it, so we didn't include it. Croaky, that's the Goldman Sachs one I'm talking about. 30% per annum. Companies in the top quartile by cash return on capital invested. So we take the research from the quantum database of the Goldman Sachs Global Investment Research Team. They have an R&D division. When I set up the hedge fund, this is the kind of stuff that came across my desk, and it bloody blew my mind. And I thought, well, look, what's investing? It's riding the coattails of the best companies in the world. Well, what's research? It's stealing the research from the best companies in the world who do all the hard work. I can't afford the kind of teams they've got, the supercomputers and the number crunching. Or even if I can afford it, I don't want to divert a significant amount of resources to just doing that. I'd have to be the size of Goldman Sachs. Okay, so instead I take their research and use it myself instead. Or it's not just me, we've got a global team. Data, graphics, and then IT, a lot on that. Automation now, just hired somebody to do AI automation because I want to try and get things more automated. We used to do a lot of things manually. Bernard is, these are some of the positive comments I've had anyway about the work that I do. My ambition is to, this is the AI pick, the Broadcom one, and that was just to 2023. The AI stuff is still for fun. My ambition is to knock, well, it's actually to make St. James's Place bankrupt, make it insolvent, because I think what they do is an absolute scam and a travesty. I know that every one of their clients wouldn't ever, all 900,000 won't ever become sufficiently confident to do it themselves, even if you give them the data and the information and say, this is what you should do, which is suited to your risk profile. You'll still get some saying, just take my money, please, and just try and beat the bank interest account. But it's a good target to have, a company like that, and so get rid of it. And that's my goal. I want, like Airbnb doesn't own properties and Uber doesn't own cars. I want to have an asset management company floated on the London Stock Exchange, and I met with them twice now, which, and I'll tell you why the London Stock Exchange in a second, which you keep your assets. You don't give it to a fund manager, and you don't get charged fees. You get given the data and the education, and you only pay once. And so it's a completely revolutionary model like Uber was and Airbnb was. And people pull their money out of St. James's Place, which we've seen them doing, and they manage it themselves, just as all the people who bought my books or read my articles or watched me on the BBC do. 20% return on a 500k SIP or ISA is 100k. That's just numbers. That's what it is. Okay, it's just how it is. Okay. The two things people want, we worked out. We've really narrowed it down. They want the data. Of course they do, because with data, knowledge without data is pointless. Then you've got knowledge, but you haven't got the information. And similarly, data without knowing what to do is useless. They want the process and the knowledge, but they don't want to read books. They want to have the one-to-one tutorial. If you want to join the program, then on webinars, I take on 10 at a time. I want to get to about 350 and then get venture capitalists involved on this. My wife is global head of the venture capital unit in the British government. And I think I'm sure she'll help open doors. I know quite a few venture capitalists myself, but that's the ambition. Once we get to that number, and then we'll think how we price it up. Paresh, also one of the people who works with me, he wants to raise the price now by last year's returns, 40%, and I think we're going to do that. I think we're going to put the price up again by 40%, because 40% is what it went up, the market up. I've sort of been resisting a bit and saying, look, Paresh, we're going to annoy people in the future. Evaluate your portfolio. We'll do all of that. We'll do all of this basically. Okay, help you learn how you can track it so that you're in charge. It's your side gig. It's your new business. If you want to speak to Paresh and want a tour, he created all the strategies for a hedge fund called Marble Bar, and he put them in this, which we co-authored together, by the way. Sometimes people think, oh, he's just the lackey. He's not. He's actually incredibly clever. Right, I'm going to go through some of this. What would you say this is Chinese year of the overbought stock? Wait a minute, Gavin. I'm going to answer these questions in a second. Let me just go through that. If you want to sign up, it's going to be first come, first serve. Okay, so first 10, that's it. Those who've got links, there were one or two from the last webinar who said hold a place, and we sent a link. Those links are going to be void as of Friday when we put the prices up. So just so you know, those links are no longer going to be valid. Final minute leads winning. Look at that. Thank you. Made my day. All right. It's one-off. Yeah, it's one-off. Now I'm going to answer your questions as I go through this. But yeah, now you know what my ambitions are. Why London Stock Exchange? Because they will take on smaller sized companies than NASDAQ. NASDAQ, you've got to be massive. So I want to start at that small. I want to get on first, get in funds, and then eventually maybe go to the US. Thank you, Alpesh. Super webinar. Any comments on BBAI? I don't know BBAI. Let me have a quick look for you if I can on that one. Okay. Oh, I should say, if you go to this site, you'll see a whole load of information. alpeshpatel.com/shares. You'll see we teach people stuff. You'll see all the performances and the breakdowns over there. But you'll see we teach people a whole load of stuff as well. And you see the stuff that we teach. Okay. Over there, and you'll see also how it works. And there's a lot of, watch these preview stuff. You'll learn a lot in terms of how to clean up a portfolio that you might have messed on, why pension's only up 20% in 10 years and the market's up 400%, why that happens, and how many stocks you should have, and why your IFOs are not doing so well. Okay, so you might find that useful as well. Okay, so that's all there, and we've also got interviews with clients on there as well, which I think you'll learn a lot from, and what people are doing, why it works for them as well. We did it in videos so that it's, well, clearer as well, and then there's a whole load of stuff there and some more videos there. God, we've got a lot of videos, and then some TV videos. Okay, cookies, testimonials. Anyway, enough of that. What I want to show you now is, what was BBAI? BBAI. BigBear.ai. Well, I think, look, if you, again, you've got a load of buys here. It's obviously a penny stock. It looks quite volatile. I guess if somebody, again, put a gun to my head and said, look, what's likely to happen? I'd say, okay, if it's going to do that, but you probably want to put a stop loss somewhere. I mean, you might say, listen, I think I could make 100% to the upside, Alpesh, so I'm willing to risk losing all my money to the downside. Or you might say, you'll put a stop there or here. This is more like traders, and let me put it this way, I won't put it in my, I'm not going to risk my son's inheritance on it, am I? Obviously. So that, you know, maybe you do that, 50% to the downside, 120 to the upside, but good luck. I'm not going to put it on red at the casino either. So I only tell people what's suitable for a pension. I'm not sure that is. Crikey, more peaks than the Alps. I like that. What happened with Oxy? Oh, I thought I had Occidental on here. Sorry, let me just show you. I apologize. So Oxy's been falling a fair bit. Best case scenario would be suddenly it turns around, but that MACD is giving you the best clue as to what's happening. It's just falling too steeply for the moment. So I'd probably say, I mean, unless by some coincidence today is the low, but I suspect it might not be, and it'll probably hit where would be the next support? Maybe closer to there-ish. So let me see, maybe worst case you've got another 26% to the downside. Best case you go up 50%. Today's the low, but at the moment that's where it is. So I'd probably say if you're in Occidental Petroleum, Goldman Sachs issued a sell note on the 31st of Jan. I'd probably say probably want to wait it out a bit more, don't you? Any other questions? Oh, thank you, Glyn. You're very kind. Ross, I'm curious why you got MicroStrategy. Did it actually tick the value growth box? Or just no, it can't just tick momentum. It has to be value growth, income, cash flow, Sortino. There is another batch, what we call special situations, but that wasn't it. It was value growth, income. Now, let me put it this way, and this is where people sometimes misunderstand. They say, yeah, but the P is so high. How could it be value? If something is expensive, but the growth is phenomenal, and the Sortino is really good, those other factors can outweigh it. Do you see what I mean? It's a bit like the example I give is, let's say I'm deciding who to marry, and I say, well, this is going to sound sexist, but I can't think of anything else. I say, oh, she's not a good cook, but she's going to make a lovely mother. Then you see one thing outweighs the other. So it's like that. It's like any other algorithm. Whenever you make any judgment, all judgments are based on what's important, how important is it. And when you mess things up, whether it's life, marriage, where to go to eat, what you've usually messed up is you've thought about irrelevant things, or you've given weight to things more or less than you should have done. So it's not just valuation, and that's what people often get wrong. Or they overweigh momentum and not enough weight on value and growth, or they give too much weight on value. The biggest mistakes are they give too much or too little weight on momentum and value. They give too much or too little weight on that, and those are the two major factors. Okay, so that's what those are. Let me see what else we've got. So weird. Sorry, excuse me. I'm looking at the wrong thing, I think. Glyn, IFA charged me over the next 12 months to see who can get the best returns. Any tips? In the past 12 months, he's up. Well, of course, in the last 12 months, that's pretty shitty anyway. Okay, Kieran, I'll tell you a good way to cheat on that. If, as is probably the case, the S&P is going to be up, just do 2 times leverage ETF on the S&P, okay, and you'll beat your IFA. It's as simple as that. In fact, forget that. Just do the S&P and you'll beat your IFA. All right, because your IFA was below the S&P last year. I've just noticed it was up only 18. The S&P was up 25. So they're going to underperform anyway. So as long as it's an up year, 2 times leverage would mean you trounce your IFA. Thank you. Au revoir, Marguerite. I love that name. BBA went up 47. Yep, I've done that one. Any other questions? What's your take on DeepSeek? Well, as things stand, as I said on my Telegram channel, much ado about nothing. As we've seen, as what's happened. So I think it's irrelevant for several reasons. One is, if it looks like they cheat. Well, it looks like what the Chinese did. What the Chinese do? They produced a cheap version using Western intellectual property. They stole a load of data, then added a bit and said, look, we did it cheaper. Well, no, that's like me saying I took all the design plans and intellectual property of how to build a TV, and then look, my TV's cheaper than yours. Well, I still don't want your bloody TV because I'm Donald Trump, and I'm not going to let a Chinese AI be on penetrating us if you're using our intellectual property, and that's going to happen. Okay, so it's just, and as you can see, what actually happened was a whole bunch of scaredy cats panicked themselves, and they absolutely wet the bed. Which, as you've watched my comments on last Monday, why didn't Warren Buffett panic and say this is the end of Western civilization? Why didn't anybody with any sort of sense of judgment do it? Retail clients panicked, and then they bought back in. I've taken time to read your books, and from trading strategy that allowed me to get 25% in the last 6 months. Thank you, Chaz. Oh, I'm so happy. I'm going to share that. Delighted. I am glad. Never become complacent, though. I would say broadcast comment to room. Okay. Thank you all. Thank you. Do you include leverage? I think I answered that. If there's anything I'm missing, Michael, I still need to know why on earth would you say 3-0 Coventry? Going to find out which Michael that is. Gary Russell to Leeds. Yay. Okay, Gary, I'm going to answer any of the questions. Should I be taking profits in my SIP? Gary, it really depends on your risk appetite. If you're asking the question, it seems to suggest you ought to, because you want to have peace of mind. If I knew what the future was, I'd either say to you, buy this really risky company because I know guaranteed it's going up, which I don't. Or I'd say, well, actually go by your risk appetite. So if you feel, and don't forget, taking profits doesn't mean 0 or 100%. This is what people get wrong. You might just take a bit of money off the table until you're comfortable. The reason you have a pension, a SIP, or an ISA is because you want a peaceful life. So the journey has to be peaceful as well. And that's probably the best thing I can say. Stronger dollar. I mean, I'm confident in mine. I'm not taking money off mine, just so you know. Not yet. I'm worried that we could have a down year, but I don't think we will. You'll notice from my discussion, I don't ever go gung-ho on things. Okay. I think I've answered everything. Let me know if I've missed anything. Repost it or just email me. Sorry, Glyn, you've got to go. I've got to go as well because it's past 10. Then NVIDIA correction could be an investment opportunity. Thanks. Juan, I'll keep, let me look at NVIDIA. I'll tell you what the problem with NVIDIA is for some people. Okay, everybody wants an NVIDIA, but nobody, it's like everybody, what is it? Everybody wants to go to heaven, but nobody wants to take the journey. I think that's what they say, isn't it? So the problem with NVIDIA is this. I want you to show you something. Okay, that's 34% drop, and it still went up. Okay, and there was a prolonged period here. Well, if you follow me, you'll know I kept saying, oh, look, it looks like it's going to fall, but my exit hasn't come in. The exits never came in, and then it went up, which surprised me. Now, what I'd say to you, look, I'm going to give you a little cheat, okay, with NVIDIA. I'm going to give you a really good cheat. Don't tell anyone this one. Do you see this? You can get this from TrendSpider or TradingView, okay? Do you see that? If that crosses below the yellow, and I don't mean a little bit, I don't mean kisses it, I mean crosses, okay, below, like it did here, then get out, okay? But you might be seeing a 34% drop. Until then, if you see drops, don't panic. It looks like it might do it, but we don't know until we know, all right? We don't know until it knows. Don't preempt it, all right? Don't panic ahead of time, okay? I'm going to go. Any other questions, please? Everyone who's signed up, thank you very much. If you've got any questions, let me know. If you want me to hold a place for you, let me know as well. Who else have we got? I've got a question about exit rules, about 7 comments up. If you could indulge me. Gavin, I will indulge you. I will. Alan, you take that wine, my friend. I'm teetotal, but I'm gonna treat myself to something. I don't know what. Probably an apple. Because WB has been hoarding cash. Yeah, he's got very strict criteria. If you can't find something, and we find it harder to find good companies which are undervalued and so on. Gavin wrote, oh God, I've got quite a few questions here. Gavin, bending the exit rules a little. If I have a stock that's down 10% and I have 2 months to go, so on downward trend and history suggests it takes 6 months to go, is it reasonable to take the views? Oh, I think that's fine, Gavin. I think that's fine. I think you summed it up perfectly, and I think that's perfectly fine. Ravi asked about Atos Origin, the IT company. Sorry, the whole bunch. It's really weird. I've got some questions which haven't come up for some reason, and I'm seeing them anew. So apologies for that. Oops, sorry. Atos AI. What did you say? Atos. Was it an AI one? Can you send me the ticker symbol? Just put the ticker symbol, will you? Do me a favor. Isn't entry timing really important with leveraged ETFs because volatility decay, S&P goes sideways, leverage? You want rising momentum, Kishan. That's why you want rising momentum. You can see it on screen here. You want that to be rising because otherwise, if it goes sideways, you've got, as you rightly said, volatility decay. Okay. So you could have timed it by buying it there. So much for timing, eh? There. So anyway, any point within those that 1 year period. Yeah. So people sometimes use these terms in sort of abstract. Oh, you got to time it. Well, is it really called timing if you've got a bloody 6 month window? Probably not. Okay, so yeah, you just want to see that rising, and you never want to do it when that's falling or flat. You want to avoid flat to falling. Okay, Atos Origin. I need, Ravi, the ticker symbol. Yeah, I haven't got it. Is it a British company? Looks like it's a British company. Let me answer a few other questions. Good, because NVIDIA correction should be an investment opportunity. Juan, let's look at it when it happens, because it's not a question of it'll be an investment opportunity. It's about when might it be. And you don't want to anticipate that, because I'll give you an example. Let's look at NVIDIA here. Was it an investment opportunity at this point? Or this, or this, or this? There were some better times than worse times, weren't there? So what I say with hypotheticals is you're asking two chess moves ahead. First, it's got to fall, and then when's it a good time to buy once it's fallen? Let's just wait until that happens. We don't need to worry about it tonight, do we? No. And that's often what people sometimes they think too many steps ahead, private investors. Okay, Atos. ATO. Must be British. Does it exist? Is it this one? Is it this one? Right, guys, I don't know. It's some kind of specialist company. I'm never going to find it. I don't know where you guys get these things from sometimes. Atos. And whoever created the name. No, sorry, don't have it. Is it this one? No, sorry. Not one for me, guys. Sorry. If I can't find the data that easily, then it's certainly not one that I'd want to go near anyway myself. So I couldn't even tell you. Atmos Energy. Atos SE. That one. Why does everybody call their company Atos? Look. Yeah, sorry. I don't know. Is it this one? Is it that one? Is it this one? Is it that one? Okay, forget about it. What I'd say is sell it. Get the hell out of there. Because if people can't even find it, then ain't nobody going to be sticking around with it either. And they're not going to be buying it. And I think that tells me everything I need to know about it. Get the hell out of there. DAGB. Oh, God, no, I'll have to do that offline. Sorry about DAGB and all the rest of it. Okay, Leslie, I can't find it, which means I suspect a load of other investors couldn't care less about it either. It's got a name which is difficult to find, which means it's probably incredibly illiquid. It's probably one which is mentioned in a newsletter, because what they're hoping is they can pump and dump the crap out of it because it'll be illiquid. How do I know it's illiquid? Because if I can't find it, then it means there aren't many people buying it, and newsletters often do this. They pump and dump the crap out of it. Okay, so I would say, leave it alone and dump it. And that's my official view on it. So you can tell Gartner's Magic Quadrant. You can tell Gartner's Magic Quadrant. Alpesh is shorting Atos. Put it on social media. I'm shorting Atos because I think whoever's created the company came up with a rubbish name, which wasn't unique, and they put it on a hard to find index. So short it, if anything. In fact, I'll probably tweet that. Short Atos. Okay, guys, I'm going to go. Thank you all very much for everything. And I hope you enjoyed the webinar. I'm going to make a move. I'm most grateful for everybody who's been on. So thank you all. And yeah, thank you. As well. Sanford, I will send you a note as well. Thank you all very much. No worries. Oh, do I have a look at that as well? Thanks, everyone. I will see you soon.